The stock market has delivered an impressive run year to date, but that strength has come with a cost. Valuations across many companies continue to stretch higher, even as earnings rise, and retail investors are starting to notice. Back in April, we can see that they were buying every dip at record levels, and today, well, in fact, their conviction has started to cool, and dip buying activity has dropped sharply. What's interesting is that JP Morgan recently suggested that any pullback should still be bought. We can see, in fact, they believe the bull market is going to continue for quite some time, but retail isn't listening. Well, in fact, neither are the institutions. We can see they've been steadily selling several extremely popular names, and it's not just them. We've even dug into the latest moves from members of Congress, and they've also been unloading shares across a wide range of S&P 500 companies. So that does raise a key question: when should you consider selling or simply holding a stock instead of buying more? We can take a look at a few examples. We can see AbbVie trading well above their 5-year historical valuation while offering a yield below their long-term average. We can also see the blue tunnel, which does in fact depict the fair value, also signaling potential overvaluation as the stock price sits above the upper end of that intrinsic price tunnel. And this isn't something that's unique. We can take a look at other companies, for example Hershey, also mirroring the exact same setup. When we take a look at the blue tunnel again, it does in fact sit above, and as we said, this does relate to many companies. We can see the same for Starbucks, we can note that for FedEx, General Dynamics, 3M as well, showing the exact same thing. And whilst we're not going to break down each one of these in detail today, we're going to use these same criteria where we've identified 7 stocks that currently look overvalued, and notably many of them have also been sold off by members of Congress. So let's kick things off with stock number 1, Apple, where we're going to talk through the valuation, the risks, and why it may be time to rethink holding. Now, first one, as we can see, it is up 17% over the last year. Year to date, also strong, up double digit, where over the last 10 years, they've massively outperformed the S&P, up 904%. They're also trading pretty much, as we can see, near not just 52-week high, but all-time highs, where we get a double hold from Seeking Alpha and Quant, a weaker buy rating from Wall Street at 4 out of 5, and we notice they're trading at one of the highest valuations than what they have in the last 5 years at 34.5. It's also significantly higher than their 5-year average at 27.8, so our first potential overvaluation signal. We won't cover the yield because it is fairly trivial, but interesting to see their lowest forward P was at the beginning of 2023, around 20-21 times, and the highest, well, not too far off the 34.5 that we've seen, sit around the 36 mark a number of years ago. And on the blue tunnel, we do get that potential overvaluation signal as well, where we can see it trading above the upper end. It's something we've noticed quite often in just the last year, but it's not also the first time when we zoom out to the last 10 years. Apple is a company that does typically trade, and for quite long periods, at a premium overall to their fair price. We've seen this continually, something we're also noticing again today, and we have done for most of 2025. And as we've just covered the valuation, well, against the sector, they are trading at a 44% premium. We've highlighted they're trading at a premium to their own 5-year average, but this is a company that you would consider being one that is growing fast. In fact, that is not what we're seeing, and perhaps that is why the price earnings growth doesn't look appealing at all. 3.34, we will reiterate, we want to see this below 2 to consider it an opportunity. That's a near 100% premium to the sector, but look, historically it sits at 2.65, much lower, so a 26% premium, and their growth also not looking great at a D-, but you shouldn't be surprised. It has been a long time since we've really seen Apple bring out anything that is very innovating. Now, year on year, top line's up only 6.5%, expected around 7 over the next year. What's fascinating is that the sector, which is valued a lot lower, is in fact projecting revenue to be higher, and that's what we've also seen historically too. And even Apple over the last 5 years, one thing to note, not in fact that impressive in the high single digit, but actually we're seeing their revenue slow down from what was already pretty slow for a previously fast growing company. Earnings per share very disappointing, 10% projected over the next 3 to 5 years, which is below the sector at 15 and also lower than their own historical, so not looking good in the growth department as well as the valuation. And our intrinsic price gets to $184 derived from the discounted cash flow model. Now, first things first, we can see in the most recent year, their free cash flow dropped 9%, their 10-year CAGR sits at 7%, and whilst you could look at the 8% and say perhaps it is a little bit more on the conservative side, we've actually got this at the lower end, and whilst we do typically use the middle rate for companies we analyze, for Apple we actually believe this one probably to be the most reasonable today. Now you will notice on a reverse DCF, this is highlighting if you're paying $284 today, which is the market price at the time of the video, baked in today is 14.1% growth to their future free cash flows. Now we do see this already as pretty high, and even if you use the upper end of 12%, which we can highlight today, at $245, you can already notice the overvaluation signal here, negative 14%. Now as always, these numbers that we use are subjective. You can grab a copy of this model by clicking on the pinned comment below, but by using the 8%, we want to understand what is the margin of safety on offer today. No surprises, as the share price is higher, there's no MOS, you're in fact paying a 54% premium. Typically, to get us really excited, high quality company, we want a 10% MOS. That would be if they meet the 3 criteria: wide moat, strong financial metrics, good forward-looking data, which if you believe that to be appropriate for Apple, we would say a buy at $166. So right now, doesn't look like one for serious consideration. And even Wall Street with their 4 out of 5 buy rating see this at $290 into next year. That is only 2% upside. Now we'll also flag for what we typically use the middle rate at 10%. You will probably be aware now there is no margin of safety on offer. It just shows the premium getting small at 34%. And we'll go one step further for those that believe the numbers are too low. At 12%, you are paying a premium, still very high, even for a company like Apple at 16%. So let us know, stock number 1, whether you believe Apple is a buy, hold, or maybe one to completely avoid. And before we move on to stock number 2, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks, as well as what's gone on in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is American Express, up 22% in the last year, year to date up 24%, very strong, outperforming the S&P. Also that same conclusion over the last 10, up 435, very similar to what we just saw from Apple. They're trading very near 52-week and all-time high, but unlike that company, we get a triple hold right across the board. Bear in mind 3.5 is what is needed to flip it into a buy rating. And we also notice forward PE 22, one of the highest in the last 10 years. In fact, higher than that, you'd have to go back to around the end of 2021. Also above their 5-year of 18.2. Lowest this one has been was around 13 at the back end of 2023. And the yield still trivial, but you can note you're getting 0.9%, whereas the average sits at 1.2. And the blue tunnel also showing that overvaluation signal. Interestingly, during Liberation Day, this one entered into an undervalued level. So make sure as always you're subscribed, notification bell is on. When we see high quality companies enter this level, we will let you know. But also interesting to see, zooming out to the last 10 years, American Express is a company that very rarely does enter into a severely undervalued level. You could see here back in 2023, that is probably where we were last notified. Valuation also not the greatest. They are in fact trading at a triple digit premium to the sector, 28% premium to their own 5-year average. And if you want to look at a price to earnings growth, we did just say around 2 or below gets us excited. The thing that isn't the greatest to see is their own 5-year average on a PG basis sits much lower at 1.48, hence the 35% premium. Now their growth does look a lot better at a B-, year on year up 10%, expected 9 over the next 12, slightly higher than the sector but also growing slightly slower than they have done historically. Earnings per share were projected to be around 12%, pretty much in line with the sector, but a lot slower. Historically, AXP were growing EPS 21% year on year. Now, our intrinsic price is the average of the two models, both DCF and DDM, which are fairly similar, and it comes to $355. Solely looking at a discounted cash flow model, though, for your information, we've used 4% growth rate, 10-year CAGR sits at 3%, baked in is around 4.3, may give you a rough idea whether you see this already as over or undervalued, but unlike Apple, where we saw a massive double-digit premium, for American Express, we do see this one as slightly overvalued, a 4% premium. Now, you like the company, you want to get a few targets, well, at 10%, potentially a buy at $320, at 20%, 284, and 25, 267. Wall Street, as we just saw, triple hold across the board. They anticipate $352 into next year. That is actually downside of 4%. But give us your views, American Express. Maybe this is one you like for the longer term setup, or maybe one in which you believe there are better opportunities elsewhere. We then move on to Walmart, up 22% in the last year, 27% year to date. Over the last 10 years, another outperformer, up 478, also trading pretty much at 52-week and all-time highs. We get the first strong buy from Wall Street with a double hold from Seeking Alpha and Quant. Now, they're trading at what we would say is a ludicrously high forward PE, 40.1, the highest in the last 5 years, probably the highest ever if we did have that data available, significantly higher than the 5-year average at 24.6. This one at the beginning of 2024 was in fact trading around a forward P of 23 and has continued to run up from then. And the yield, well, you're getting 0.8%, historical average 1.5. And no surprises whatsoever, this one is trading at a premium, one that we've seen for all of the last 12 months. Huge disparity that's only gotten larger and larger in the last few weeks in terms of the stock price versus the upper end of the fair value. And probably surprised to see that over the last 10 years, this one does typically trade at a premium. There was a year or so where it traded in the reasonable signal, but Walmart, maybe there's a reason for that. It has historically traded above the fair value, but what we've noticed from 2024 onwards, this premium is the highest we have seen. Just look at the premium in 2018 through to 2021. It was a lot smaller, so perhaps one we would say today is on the severe overvalued level. And no surprises, F on valuation, triple digit premium to the sector, 59% premium to their 5-year average. Price to earnings growth, now as we've said before, doesn't apply to all companies, but if you want to see it here for Walmart, triple digit premium to the sector, 50% above their own 5-year, and their growth sits at a C. Now this is ludicrous. You're paying 40 on a valuation for Walmart. They're growing in line with inflation at around 4 to 5%. Yes, it is above the sector, although on a very trivial basis, and also in line with their 5-year. So this tells us Walmart typically grows revenue 4 to 5%. That's only keeping up in line with inflation, yet their valuation continues to get higher and higher. Earnings per share also nothing glamorous, expected 7.9% over the next 3 to 5. Yes, above the sector in the mid-single digit, but again, pretty much in line with their own historical. And our valuation does reflect that. We've got $85. Now, we want to be honest, this is a little bit optimistic. We'll just explain, because on a DCF, it's a lot lower at $68. And if you solely wanted to use the DCF, well, look, we've used 15%. In reality, it is probably very unlikely they'll be able to grow future free cash flow at that rate, and baked in today is 21.9%. So really, if you use 10%, which again you could argue is on the more optimistic side, intrinsically $46, that is double digit downside, quite severe of 60%, and that would also drop the intrinsic price to $78. Now, we'll use the middle rate of 15%, but in reality, it doesn't make a massive difference to the intrinsic price. The conclusion is very, very clear. MOS, well, no. Premium, yes, at 34%. Wall Street, even with their strong buy rating, see 122 into next year. That is 7% upside. So give us your thoughts. If you wanted to make note, at 10%, well, a buy at 77. At 20, a buy at 68, and 25, $64. and it's a very similar setup to Costco, but and maybe surprisingly, if we had to pick one right now at their cost price, Costco does look like the better opportunity, but both of them do look overpriced. We then move on to Caterpillar. Phenomenal run, up 48% over the last year, 63% year to date, maybe one of the best in the S&P looking at that level, and over the last 10 years, well, up 804%. You could have literally bought this, we're talking in 2025 during the Liberation Day lows at $293, so you would be up pretty much double, which is phenomenal to see, and as of today is trading at a 52-week an all-time high. Yes, we get one buy rating from Wall Street, but that is very weak, with a double hold from Seeking Alpha and Quant, and they're also trading at a ludicrously high forward P, 28.5, pretty much the highest in the last 5 years. We do notice a few weeks ago it was sitting above the 30 mark. Look at this, in 2025 Liberation lows, it was trading around 14, which was below the 5-year average of 16.8, which is why you can always use this to help your investment thesis, but the disparity is very huge. Overvaluation does look like a real possibility, and the yield sits at 1%, historically around the 2% level. And Blue Tunnel, no surprises whatsoever. From July, disparity has only gotten larger and larger, whilst bear this in mind, the intrinsic price has pretty much stayed flat. Not a good sign whatsoever, where over the last 10 years we can see firstly intrinsic tunnel does increase, but very minimal, and we're seeing probably the largest premium against the upper end of the blue tunnel. Definitely a bit of a warning sign, and that's reflected in their valuation grade at an F, 54% premium to the sector, 72% premium to their 5-year average. Price to earnings growth, if you want to see, 4.2. Yes, triple digit against the sector, we would expect that, but their own 5-year average sits a lot more appealing at 1.67. You're paying, and for the first time I believe we've seen a triple digit premium against their own 5-year average on the price to earnings growth basis. So what does the valuation tell us? Well, we get to $494, actually pretty much in line with the DCF, where their 10-year CAGR sits at 10%, in fact on a reverse basis around 10.1. We have used, in line with analyst expectations, around the 8% point, and you can in fact notice, incorporating all three models today, a 20% premium. Now Wall Street, even with the weak buy rating, they see $601 into next year. That's only 2% upside, and if you really want to see this at an MOS of 10, well, a buy at 444, at 20 a buy at 395, and 25 370. Let us know with Caterpillar, maybe you agree or maybe you do strongly disagree. We then move on to Oracle, up 14% in the last year, year to date up 25, over the last 10 outperforming the S&P, up 458, trading towards the lower end of the 52-week range. Very interesting. At one point this one was trading at $346, where we did a similar episode and we did say this one was severely overvalued. Now we have a more respectable buy rating from Wall Street, but still a double hold from Seeking Alpha and Quant. Their forward P sits at 29.3, which both in isolation and against their 5-year average looks very high. At the peak, this was sitting around the 45 mark. Yield also lower than their historical 1 versus 1.4. And the blue tunnel, even with the drop we've seen in the share price, in fact peaking around September, whilst it has continued to come down, still showing the overvaluation signal. In fact, during Liberation Day, it didn't just drop into potential undervaluation. In fact, it dropped into the reasonable signal. Tells you a lot about how overpriced the company does currently look. And that is fascinating to see. Over the last 10 years, this one more often than not did trade in a reasonable signal. From 2023 onwards, it traded at quite a large premium, and we're noticing that massive run it had, huge overvaluation, probably the largest disparity we've seen. And again, reiterating what we said, as it has come down, still does look overvalued. Now they're grading at a D-, you're paying a 27% premium to the sector, 43% premium to their 5-year. Price to earnings growth, although bear in mind these are on the expectations moving forwards, 1.34 actually looks attractive. The first one we've covered today with a discount to the sector, that's 22%, and a discount to their 5-year at 31. And their growth comes in at a D+, grew top line 10% last year, projected to grow faster over the next 12 at 16 on both accounts, above the sector and growing faster than they have done historically. Good to see. Earnings per share, again, if you do believe estimates, well, 23%, which is significantly higher than both the sector and their own 5-year, which sit at 15 and 11 respectively. Now, intrinsic value, $193. Bear in mind, we've used a growth rate of 20%, which you could argue 15 is more reasonable. Nonetheless, on a reverse basis, 21%, it's higher than both the low and medium. If you think, you know what, 20% is reasonable, still a premium, we're talking 7%. If you believe 15 to be what you would expect over the longer term, well, the premium only naturally gets larger at 55%. On both accounts, Wall Street are in complete disagreement. They see $354 into next year. That is 71% upside, and that's fascinating because even if we use the upper end of 25%, that is still lower than what Wall Street anticipate, and we can try 30% in the model, which as always, you can grab a copy by clicking on the pinned comment below. It's slightly above what they anticipate, telling us Wall Street see their growth of the future free cash flow between the 25 to 30% level. Regardless, we see probably more reasonable at 15%, which does in turn highlight a huge premium. Let us know though your views on Oracle today, and maybe you believe Wall Street with the more appropriate numbers. We then move on to Nike, down 17% in the last year, down 13% year to date. Over the last 10 years, barely made any money if you bought this 10 years ago today, on a decline from the highs that we can in fact notice from November 2021. We're talking more than 4 years ago, and it's trading around the mid to lower end of the 52-week range. Buy rating from Wall Street, you could see a bit of a weak one at 4.02. Double hold from Seeking Alpha and Wall Street, and the forward P 35, again very, very high in isolation. Even though it is around the 5-year average, we still would say potentially overvalued. Unlike the previous companies we've covered, the yield of 2.5% is actually above the 5-year of 1.3, and we also get a reasonable signal. It is sitting pretty much around the mid to upper end of the blue tunnel, but also do factor in the blue tunnel itself. The expected intrinsic fair price has started to come down quite sharply, where over the last 10 years it doesn't paint a very pretty picture. But always remember, whilst we do incorporate past performance, past data, it doesn't reflect on how they'll perform in the future, so we could see this as a turnaround play. Now, valuation comes to a D, where they're trading at a 131% premium to the sector, 14% premium to their 5-year. Price to earnings growth looking attractive at 2.15. Whilst it is above the sector, their historical sits at 4.2, so actually PG a 49% discount. But this looks dreadful. Growth C-, year on year down 7%, expected down 1% moving forwards. Sector not great, but still at least positive, and their own 5-year also positive in the mid-single digit space. Again, if you believe they can execute, well, EPS projected 18% moving forwards, above the sector at 10 and their own 5-year at 12, and our intrinsic price comes to $54. DCF actually a little bit higher at 60, where their 10-year CAGR sits at 4%. That is growth year on year. We've gone for 8% moving forwards. Baked in is slightly higher at 9. Nonetheless, conclusion is very clear. For Nike today, you're paying a 20% premium. If you wanted a margin of safety, well, even at 10%, it comes to $49. At 20%, $43, and 25%, $41. Wall Street actually in disagreement, like we just saw from Oracle. They see this at 86 into next year. That is 32% upside, but give us your views, maybe one you actually disagree and have started to add. We then move on to Johnson & Johnson, up 35% in the last year, up 42% year to date, one of the best performing in the S&P, like we've noted from a few today. And over the last 10 years, well, it has still underperformed the S&P, even with that strength in 2025. Also trading pretty much around 52-week and all-time highs, and I believe probably the first time we've got a double buy rating on a company today, both though on the weaker side, with quant giving this a hold. Is also trading at a forward P of 18.3, the highest going all the way back to around 2021, slightly above the 5-year of 16, yield 2.5, slightly below the 5-year of 2.83, so you could argue double, potential slight overvaluation. And that's also noted on the blue tunnel. It is slightly sitting above the upper end, something we haven't noted in the last year, and also something over the last 10 years extremely rare to see. Johnson & Johnson actually trades more at a discount than it does at a premium, so this is entering a bit of rare territory for the company. Now, their valuation sits at a C-, pretty much in line with the sector, a little bit higher, 17% than their 5-year. Again, probably not appropriate, but for consistency, PG at 2.7, above the sector at 1.8, but a 21% discount to their 5-year, where their growth doesn't look great at an F, 5% year on year expected there or thereabouts over the next 12, little bit below the sector, but pretty much around the same levels as we have seen from them historically, where the EPS projected 7% growth is lower than the sector at 10, but interesting to see is actually above their historical 5.3. Now our intrinsic price gets to $174, which is ultimately the average of the 4 models we see on screen. DCF does come in higher at 196. Now 10-year CAGR, not great at 1%. Most recent sits at 10. We've gone 6 moving forwards, where baked in is there or thereabouts at 6.6. But using all 4 models, we actually note an 18% premium. Even with the double week buy rating that we just saw, Wall Street forecasts $208 into next year, only 1% upside. And if you wanted this at an MOS, well, 10% a buy at 157, at 20 a buy at 139, and 25 $130. Maybe you agree, maybe disagree, or you see perhaps Johnson & Johnson as a hold in a long-term portfolio. Do give us your views. And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.